Hey, Archie, what if I really like it when the stock market goes up, but I can't stand it when it goes down?
Well, Rob, I've got a couple ideas for you. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP professionals Archie Hoxton and Rob Hoxton. And today, we're going to be discussing a topic that was requested by one of our listeners, Missouri 6014. Thank you very much for the idea. It's a great idea, one that is really common, especially among retirees who maybe are a little more risk averse, don't love the idea of having their money fully exposed to the markets, and want some alternative ideas for taking some risk off of the table without completely, letting it sit in cash or going all bonds, and just having a little bit of limited participation in the equity markets. So there's two specific tools that we're going to talk about today. The first is called the Buffer ETFs. The name reveals a lot. You're kind of buffered from the full brunt of the market activity. And the other is called Fixed Index Annuities. So that they're two very different products that accomplish similar objectives, but with different trade-offs. So
Right.
We're going to kind of go into that. So, I mean, this is a super common thing that people are curious about, especially if they've recently been through some sort of event in the market that freaked them out, close to retirement. If we had earlier this year, we had a dip in the market that got a lot of people worried. And if you're close to retirement, you might be thinking, well, should I look at trying to mitigate that risk through some sort of alternative tool?
Yeah, actually, Archie, the question that I tend to get isn't, should I find some other tool that allows me to have some of the upside of the stock market with none of the downside? I don't usually get the question that way.
Yeah.
It's usually, I don't think I can handle this anymore. Let's just go to cash and get a CD paying 4% and just call it a day.
Right.
And I understand. I mean, when you've pulled the trigger and retire,
Mm-hmm.
and you no longer have a paycheck, and you have to live on things like Social Security and the investment performance that you have from your portfolio, that can be a pretty stressful time.
Yeah.
And so I can understand why people might feel that way. The problem is that for most people, their financial plans don't work if their assets don't grow faster than the inflation rate.
Yeah.
And a fixed CD or savings rate isn't going to do it. It just won't grow faster than inflation. So it's unless you're not planning to live for very long, or you want to take pay cuts as you get older, that strategy doesn't work. So then, as financial planners, we're like professional puzzlers. We have this issue, and we're trying to figure out how to piece all the parts together. And so the idea of having something that operates like one of these instruments, a Buffer ETF or a fixed index annuity tied to a major benchmark like the S&P 500, might make sense for certain people. There are trade-offs, though.
Well, and one of the important considerations with the financial plan and the sort of the puzzle is most financial planning assumes a certain rate of return that's based on returns that we've gotten in the past or returns that we can expect in the future. And they don't really account for specific instruments that maybe have caps on the return that you can get. You're assuming a certain sequence of returns, good, bad, ugly, everything. So it's important, if you're going to use one of these, to understand the implications in your financial plan of, taking some of the risk off of the table. So let's start with buffer
Yeah,
ETFs.
let's talk about how they work, because I've never used a buffer ETF for a client. I have used fixed index annuities in the past, but Archie, can you just kind of walk us through the mechanics of a buffer ETF?
Yeah. So this is very general. We're not going to get into specifics. There are plenty of flavors of these, and they're offered by many different companies. But essentially what you have is it's an exchange traded fund. And let's say, for example, it's based on the S&P 500. It's tracking that index, so it owns those securities. But it has some kind of hedging strategy in place, usually using options contracts. And the result is that maybe, you get to participate in up to 15% in growth. That's sort of your upside cap.
So if you have a really great year in the stock market and returns for the S&P 500 are 15% or less, you get that return.
Yeah, but if it's 20%, you're capped up at 15.
You only get 15.
Right.
Okay.
Now on the flip side, and this is just an example, that the caps and downside, stipulations can vary. But as an example, on the downside, maybe it's that you're not exposed to the first 10% of downside. But beyond that, you are. So if the market's S&P 500 loses 10%, you're not going to lose anything. But if it loses 15%, you're exposed and you're down 5. Now, the way they work is that they work on a 1-year cycle. So this takes place over the course of a year. You've got to stay in for the entire year to benefit from the strategy. Now you can't. It's an ETF. You can sell it, but these sort of parameters that are built in, the cap and the downside protection, aren't gonna be guaranteed to you.
So would the price that you receive be impacted based on whether you're in the money on the options or out of the money? Potentially. So you've got a couple of things happening. You've got the S&P 500, whatever it's been doing and during your holding period, but then you've got, in addition to that, what's going on with those options contracts, which are sort of under the hood in that sort of investment engine. So they're more complicated, certainly more complicated than just buying the S&P 500 index. And you need to understand what you're investing in for sure.
Yeah. And then, this is something that you need to be able to buy and hold for at least a year.
So each year, do you have to renew it? Do you sell it and then buy it, or do you know how that works?
The time frame resets.
Resets.
And so there you need to be able to plan for that and have some shorter term money available.
So you wouldn't want to buy this if you thought you needed to get access to the money in less than a year.
Yeah. Yeah, you want to be, this is more like, think of this as like intermediate term money. If you have more liquid funds that you can access anytime, that could be other ETFs, it could be cash. You want to make sure that this is kind of like safe money that you can set aside for a longer period. Now, there are pros and cons. Like, one pro, it is liquid because it's an ETF, but you still have this time constraint on it. So that's kind of both a pro and a con. Again, it's an ETF. It's going to be lower cost than, say, going the annuity route. The annuity is going to have a whole different layer of costs and pitfalls involved with it. And then I would say the big con is giving up the upside. Like we said before, financial planning, often we're assuming that you are exposed to the full benefits of being in the market on those really, really great years where the S&P would blow away the cap. So that's another.
Yeah, and you're still, with the buffer ETFs, depending upon the product that you use, you're still likely to have some downside exposure. So you may not get all of the downside. It may cushion that a little bit, may buffer it, so to speak. But you do have downside risk.
Yeah. And this is where, it's very important to, since you're not cutting out all of the downside, and you are cutting off some of the upside, if you were to allocate all of your equity into buffer ETFs, you could potentially see a portfolio that lags behind a portfolio quite a bit that's not buffered with these ETFs. So
let's talk about the annuity sort of approach to this. I have a lot more experience with the annuity. So a fixed indexed annuity, they look like investments. They're not regulated as investments. They're regulated as fixed insurance products. And the word annuity tends to set off alarms in investors' heads. It has for me as well as a fiduciary. I don't generally like annuities in the traditional sense, although they can be useful tools. And the reason I haven't liked them is because there can be lots of hidden commissions and expenses.
Yeah. When you say annuity, it's so broad. I mean, there's good, bad, and ugly in that category. Even in the fixed index category, you can't assume that they're all kind of the same. They are so layered and complicated. And just because it's a fixed index annuity doesn't mean it's a great product. There are some that are much better than others.
Or a terrible product. The ones that we have used have been non-commissioned, with no surrender charge, and fairly short period of time to the point where you have full liquidity.
Yeah.
They almost all have what's called a market value adjustment. So if interest rates go against you, you could have what amounts to an interest penalty. That's something you need to get really familiar with if you're going to use a tool like this. But essentially, it does many of the same things that a buffer ETF does. It gives you some or most of the upside that the index has. Usually it's like the S&P 500 index, or maybe a global market index, or even real estate or precious metals. There are lots of different indices that you can use. We typically use the S&P 500. So maybe you have, like, recently I saw caps that were at 12%. So you get the first 12% in an up year for the market, and you get no downside. So this is different than the buffer ETF. You never go backward.
Yeah.
So if the S&P 500 has a minus 20 year, the worst case scenario for the investor or the owner of this type of an annuity is that they get zero return. If they have a positive return each year, that sort of resets and you have a new floor at the higher level.
Right.
So you can step up. I like these. They also, if it is a non-IRA type of an account, you get tax deferral.
Mm-hmm.
But there are some little gotchas on the tax treatment on the back end when you take it out. You don't get taxed as capital gains. It gets taxed as ordinary income. So there are a lot of moving parts.
Yeah. There's also trade-offs with this, like with the buffered ETFs, but these are a lot different. So in this case, when you hear, okay, you're not going to get any of the downside in the performance of the S&P 500, that should right away say, what am I losing? What am I paying for that?
Yeah, what's that cost?
So there might be percentage fees. That might be the cost. One of the costs is definitely that the insurance company keeps the upside. Your money is being invested, and you are being capped on how much you can participate in that investment. It's a complicated strategy or strategies. We don't need to get into it, but it's really important that you understand that you are giving something up, and you should know what you're giving up. And it might be worth it if maybe you've decided you don't need the excess return and the downside protection is just really worthwhile. And this can be a component of a well-diversified portfolio.
Yeah. Where I see this making sense, and I don't like it. I wouldn't do it myself for my own portfolio, but where I see it making sense is if you cannot bring yourself to put your money at any degree of risk in order to get a return that will over time outpace inflation, hopefully, then this is a way that you can sort of meet it halfway.
Yeah.
You can have some guarantees. Now, it depends on the solvency of the insurance company. Remember that.
Yeah, if the insurance company fails, then there's a question mark of who's going to step in and, service and provide the interest and all that on your annuity.
Right. That's really important. Maybe you don't use just one insurance company, and you wouldn't want to put all your money because there are some liquidity restrictions.
Right.
But if it's the only way that you can feel comfortable putting some of your money in an investment that will at least track a market index, then maybe you should consider it. But there's a lot to know.
Yeah. This is just barely scraping the surface with our short episodes that we do. We can't get a whole lot deeper, but if this is something that you want to explore, do some research, talk to people about it. If you're going to talk to someone who provides these kinds of products, talk to a couple of them.
Talk to us. I mean, we're happy to talk to you as well. Yeah.
Yeah, because this is an important decision. Like we said, there are certain constraints, especially on the annuity. You can be locked in for a period of time without liquidity. So it's important to know and understand before you make a big decision. But anyway, we hope that this is helpful to you. Again, if there's anyone that has ideas that they'd like to hear us talk about, like this one today, let us know in the comments. Remember to subscribe if you haven't already. Like the video, share it with your family and friends. Hit the bell for notifications so you know when we get new content. And we will look forward to seeing you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.